All right, let's jump straight into this explainer dissecting the hidden mechanics of credit cards and honestly, why they might not be quite as lifetime free as you've been led to believe. If you've ever felt the sting of a credit card bill, or just kind of wondered how banks are pulling in these staggering profits while seemingly handing out free plastic to everyone, well, you are in the perfect place. We're going to unpack the actual data and the deep-seated psychology straight from our source material to figure out what's really going on behind the scenes.
We've all gotten them, right? Those relentless phone calls offering a supposedly free card with absolutely zero strings attached. But it begs a pretty massive question. What is the actual catch here? Well, our sources take a really hard look at this, and they reveal that the whole concept of free is just a carefully crafted illusion. It's designed specifically to get that card sitting comfortably in your wallet. So let's break down the real cost and look at who is actually footing the bill.
12%. Now, that might not sound huge at first glance, but it turns out banks are making their absolute biggest profits from these cards simply because a staggering 12% of people completely default on their payments. That means millions of users are failing to clear their balances every single month. The entire system is essentially subsidized by the folks who fall behind. And the banks, they're capitalizing on this massively.
And man, if you do fall into that trap, look at what happens. You are instantly hit with what is arguably the world's most expensive loan, skyrocketing to a mind-blowing annual interest rate of 36 to 48%. The source material is quick to point out that absolutely no home loan and no personal loan comes anywhere close to this level of interest. It is an astronomical rate that quietly starts compounding the second you miss that full payment.
Okay, let's move into Section 1, the psychology of debt, and how banks are literally reprogramming our minds.
See, banks aren't just handing you a transaction tool. They are actively trying to fundamentally shift your relationship with money. Think about it. Historically, our ancestors viewed debt as a disease. It was a heavy, shameful burden to be avoided at literally all costs. But the financial industry aggressively flipped the script. They introduced this totally new mentality, presenting a credit card as an exclusive honor. They call you a privileged customer, and they celebrate your high credit limit. So suddenly, taking on debt feels like this huge status symbol instead of a massive liability.
To really understand how effective this manipulation is, it's exactly like that old saying about a frog in slowly boiling water. Your brain is essentially being trained to just accept debt as a normal part of life. That initial 50-day interest-free period, it's specifically designed to gently introduce debt into your personal history until it feels completely harmless. You borrow, you pay it back, and suddenly, living on borrowed funds feels like business as usual.
Which brings us to Section 2, the illusion of affordability, and how this plastic distorts our reality.
It is frankly fascinating how a simple piece of plastic completely warps our financial reality. I mean, what do people mostly buy with this newly found artificial spending power? Well, they buy what our source calls depreciating toys. We're talking high-priced items like top-tier smartphones or flashy electronics whose worth absolutely plummets over time. People use borrowed money to get that instant hit of gratification, but the item loses its value almost immediately, leaving you holding nothing but the remaining debt.
So the crucial takeaway here is perfectly captured in this quote from the explainer source material. When you buy things you can't currently afford, you are quite literally trading away the labor of your future self. Because you haven't actually earned the money yet, right? You are forcing your future self to clock in and work, essentially for free, just to pay off a depreciating toy that you simply couldn't resist buying today.
And here is the ultimate trap they use to keep you on the hook. Banks boldly highlight that tiny little minimum payment on your statement to create a complete illusion of affordability. It looks super manageable, and hey, they even tell you it protects your credit score. But the brutal reality kicks in the moment you underpay. Paying only that minimum amount triggers massive interest, and here is the real kicker. It is calculated straight from your actual date of purchase, not just the due date. Poof, that 50-day free period instantly vanishes.
All right, on to Section 3, the truth about rewards and who really foots the bill.
Let's actually trace the money here and see where reward cash actually comes from. When you make a purchase, say for 1 lakh rupees, 4 parties are involved: the network company, your issuer bank, the acquirer bank, and the seller. Out of that 1 lakh rupee purchase, your issuer bank keeps roughly 2,000 rupees as a processing fee. And it's from that exact cut that your tiny little cashbacks are funded. You aren't getting free money from the bank. You are simply getting a microscopic crumb from the massive fees generated by your own expensive spending habits.
I absolutely love this vivid metaphor from the source. You are essentially emptying massive buckets of your own hard-earned wealth just to squeeze out a tiny drop of reward points. You're spending thousands upon thousands of rupees just to get a few hundred back. It is incredibly counterproductive financially if you're spending money just for the sake of earning a reward.
And don't get me started on luxury rewards, because those are carefully engineered traps, too. Take the Taj Hotel trap, for example. You might be completely thrilled to score a free one-night stay at a luxury resort worth 10,000 rupees. But let's be real, who goes to a luxury resort for just one single night? The hidden cost is that you will inevitably spend thousands more out of pocket for premium dinners, drinks, and you'll probably book extra nights to make a real vacation out of it. In the end, you spent way more than you ever saved.
Let's dive into Section 4, Emergency Fund or Debt Trap. Time to bust the 45-day myth.
So many folks claim credit cards are strictly for emergencies, but here is the fatal flaw with that logic. If you rely on a credit card for a severe crisis that you cannot realistically pay off in 45 days, you end up doing what financial experts call changing hats. This basically means you're taking out brand new loans just to pay off your old ones. It leads to this vicious cycle of endless borrowing until the trap finally snaps shut on you. If you have a true, full-blown emergency, relying on a 36% interest loan is quite literally the worst possible band-aid.
Moving right along to Section 5, Credit versus Debit Power. Let's talk about who is really working for whom.
It's time to give some serious love to the highly underrated everyday debit card. The contrast here is just staggering. While a credit card actively penalizes you with massive interest for spending money you simply don't have, keeping those exact same funds in a debit account actively earns you money. With a debit card, your money actually works for you, growing passively in the background instead of you working endlessly to pay off a bank.
And get this, contrary to popular belief, you don't even need a credit card for those flashy luxury perks. Debit cards already offer massive hidden perks that most people completely ignore. Premium airport lounge access? Check. Multi-core air accident insurance and road accident insurance? Check. They even offer standard payback points. You get all of this VIP value completely without the looming risk of emotional or financial bankruptcy.
Finally, Section 6, Testing Your Financial Discipline. Time to test your habits.
Before you even think about swiping again, you need to know exactly who the banks are actively hunting for. If you struggle with emotional buying just to feel better after a long day, if you're an impulse shopper, or if you desperately seek instant gratification, these are giant red flags screaming at you to stay away from credit altogether. Banks literally design their entire system to heavily penalize people with these exact behavioral traits.
Real financial discipline boils down to internalizing this one simple balance. You have to aggressively separate your absolute needs, like real-life utilities, rent, and basic survival expenses that absolutely cannot be postponed, from your wants. Wants are just mere desires and depreciating toys that can, and honestly definitely should wait. Because delaying a want usually means you can buy it at a lower price later on, completely dodging the debt trap in the process.
So, as we wrap up this explainer, I really want you to ask yourself a tough question. Is your money actually bringing you peace, or is it quietly buying you stress? Are you using that piece of plastic as a highly disciplined tool, or is it slowly stealing your peace of mind while feeding the bank's bottom line? It's really something to reflect on. Leverage the actual power of your own stored money and make sure you're building your own future wealth, not somebody else's. Thanks for tuning into this explainer, and I'll catch you on the next one.